Hello everyone, welcome to Finance with Medson. In this video we're going to look at how to calculate the internal rate of return, better abbreviated as IRR. So the internal rate of return is simply that rate that gives us zero net present value. So in other words, it's simply an extension of the net present value, but in this case we are looking for the rate or the cost of capital that it gives us zero net present value. So I've decided to use the same question that I used in the calculations of the net present value video, so that we follow closely the relationship which exists there. So in the previous video of the NPV, when we carried out the calculations, we had found that the net present value was a positive one, which was $8,430. So in the case of the internal rate of return, we are simply looking at the rate that should give us zero net present value, not a 1, not a negative, but zero net present value. So in order for us to find that rate, we usually carry out the trial and error approach. So the first step is we have to understand the relationship which exists between the discounting rate or the cost of capital or the required rate of return and the net present value. So if you find the NPV or the net present value which is positive, in order for us to reduce this number to 0, we have to increase the interest factor here. That's the relationship which is there. So increasing the interest factor will lead to a reduction in the net present value. And then in the case where this figure was a negative, since our aim is to find zero net present value, then in that particular instance we were supposed to reduce the rate of return. But because in our question we have the positive NPV, so we have to keep increasing the interest factor here until we get the one which is closest to 0, or the first negative or any negative value. Then after we find the negative value, then we do the interpolation. Then that's how we find the internal rate of return. So let's begin the trial and error approach. So we will try to use a higher range, because at 14% we got a positive NPV. So I will try using 20%. It's a trial and error. So let's try 20%. We see what net present value we get. So if I decide to use 20%, I still get the positive net present value. So the same technique that we used in computing the net present value is the very same which I've used even here. So we realize that increasing the rate to 20%, it has led to the reduction of the net present value. But our aim is to ensure that we get a zero net present value. But in most cases, that cannot be achieved. So we have to find the negative NPV first, then after that we can do the interpolation. So what it means is we have to increase this rate. So it's a tedious process. So what I'll do is I'll try to increase the margin. Instead of me increasing it to 21, 22, 23, so I will try to use let me try 27 and see the net present value that I get. So we are trying 27% this time around. So the same interest factor in year number 0, we still get a 1. Then when we do multiply here, we get negative 31,000. Then in year number 2, the interest factor that we get at 27% is 0.7874. 0.7874. Then when we multiply this with 10,000, we get 7,874. And then in year number 2, the interest factor that we get is 0.6200. 6200. Then when we multiply with the 20,000, what we get is 12,400. 12,400. And then we go to the third one. So at this rate, the third one gives us the 4,882, and up to the last we can do the same, which gives us the present value of 1,514. So when we sum all this, it gives us the net present value of negative 486. So we just put it in brackets to indicate that it's negative, which is 486. So what it means is the rate that will give us a 0, it lies in between 27% and the rate that we just tried, which was 20%. So in between 27% and 20%, or may I simply say in between the original rate, which is 14%, and 27%. But how do we find that rate that will give us the 0 NPV? So we have to do the linear interpolation here in order for us to find that rate. So internal rate of return, we have to interpolate. So by interpolating, we get this formula here. So we have rate 1. So rate 1 is that rate which is given in the question. So in this case, the cost of capital, which is 14%. Then we have to add, so we can put it in brackets, the first NPV. So the net present value that we got at 14% at rate 1, we call it NPV1, which we will divide with NPV1, the same NPV1, minus the negative NPV that we've gotten, so we call it NPV2. Then when we find that, then we will multiply with the second rate. So the rate that has given us the negative NPV, we call it rate 2, which we subtract rate 1. So rate 1, what we had in the initial question, so in this case we had 14%, which we'll add to. So the first NPV that we had gotten was 8,430. So we have 8,430, which we divide with. So here is where a trick is. So the first NPV is positive. So we write it the way it is, which is 8,430 minus. So this is a negative NPV. So it will be minus minus, so meaning here it becomes addition. Take note of this. So we are adding to 486. So we have 486, which will add to that. Then after that, we can put this in brackets. Then again, another trick is on these rates. So the second rate that has given us the NPV in this instance is 27%. So we don't convert the rate, we just write the way it is. So we have 27 minus the initial rate in the question, which is 14, like that. Then when we do the mathematics here, after you divide, we are going to have 14% plus. So after dividing this, we have 0.9455. 0.9455. And then when we subtract 27 less 14, we're going to get 13. So doing the multiplication here, we have 14, we just bring it down, plus when we multiply these two, we have 12.2915. 12.2915. Then when we add this and this, that gives us our internal rate of return, which is 26.29. So rounding it off to 2 decimal places. Remember, the internal rate of return is in percentage. So it's this rate that we are looking for, that when we use it to find the net present value, we're going to get the net present value of 0. And then another thing is, once you find the internal rate of return, now you have to make a decision. Should we accept this investment or not? So the decision rule for the internal rate of return is that you accept the project if the internal rate of return is higher than the cost of capital or the required rate of return. So in this case, 26.29% is greater than the 14%, which is the cost of capital to the project. Then what it means is, at this rate, it's profitable because it's exceeding the cost of capital to an organization. So this is how we calculate the internal rate of return. For further questions, we'll refer to